welcome back to my channel, Commerce Education Academy. In today's video, let's discuss about the basic terms of accountancy. Okay, and in today's video, let's understand a few concepts of accountancy. Capital, liabilities, drawings, goods, transactions, voucher, debtors, creditors, sales, revenue, profit, and loss. So let's begin with the first topic, capital. Now, what is this capital is all about? Now, let's understand this concept with an example. Now, this person, let's keep his name as Hari. Now, this Hari wanted to start a business. Let's assume he wants to start a stationery store. He has money with him. Like, for example, he has 10 lakhs with him. With that 10 lakh, he invests it to start a stationery store. And that amount what he invests in order to start a business, we call that as a capital. I repeat, when a person invests the money to start a business, that money we call it as a capital. Okay. I hope I'm clear here. Let's move on to the next concept. Next concept is assets. Now let's understand this example with an example now. Now, this Hari, he wanted to start a factory. To start a factory, what are all the things he requires? What are the resources he may require to start a factory? For example, he requires machines, raw materials, labor, land. So these are the resources which he used for the purpose of operating his business. We call that resources as an assets. Okay. Now, for example, when he wanted to start a factory, he required machinery to manufacture the goods. He required the raw materials. He required labors. He required land, etc. So these are the resources with which he operate his business, and that resources we call that as an assets. Okay, they are the resources of the business. They are used by the business in its operation. So in this Hari, he is using to manufacture this materials or the products. For that, he is using all these resources, and the resources we call that as an asset. Okay. Next, we'll move to the next concept. Next concept is liabilities. Now, the liability is nothing but, now let's assume Hari wanted to start a business with rupees 10 lakh rupees. Okay, but now he has only 5 lakh. Now what he will do? He has to borrow some money from somebody, right? He has two options. Either he has to borrow from his friend or he has to borrow from the banker. Let's assume first he approached the banker and he asked for the banker saying that I want to start a business. So can you please lend me loan? So then the banker will give a loan to him, and that loan, let's assume, as 3 lakh rupees. Okay, now he wants still 5 lakh to start his business, but he has borrowed from the bank 3 lakh, and the rest 2 lakh he borrowed from his friend. That is, he borrowed 2 lakh from his friend. And in accountancy, whenever a owner borrow the money, and that borrowed money, we call it as a debt. We don't pronounce it as a debt. We pronounce it as a debt. The borrowed money, we call it as a debt. And this debt, it creates an obligation to the Hari that he has to pay 2 lakh for his friend and 3 lakh for a banker. Okay, now totally he got 10 lakhs after borrowing. So now he can start a business. So liability is just nothing but it creates an obligation, that is, it creates a responsibility that he has to pay that money borrowed, and he has to repay that money to the one from where he has borrowed the money. Maybe in this example, he has borrowed from the banker and also he has borrowed from the friend. So for the both also he has to return the money, and that we call it as a liability. Now liability is just an obligation that an enterprise or a owner has to pay the money, the borrowed money back, and that we call it as a liability. It is a financial burden. Liability is nothing but a financial burden. When it creates a financial burden, when a company or an enterprise or the owner borrow the money from a third party, it might be a bank, or it might be a financial institution, or any person from any third party, then it creates an obligation as soon as we borrow the money, and that obligation we call it as a liability. Okay, examples: bank loan and creditors. This term I'll explain in the further video. I hope I'm clear till here. Next, we'll move on to the next concept, that is drawings. Now, here the drawings is nothing but now, and the previous example I told you, this Hari started his business with rupees. What was the capital? His capital was 10 lakh, right? He started his business at rupees 10 lakh. Okay, now he has 10 lakhs in his business. Now, what happened? In that 10 lakh, he withdraw 2 lakh rupees. Okay, this is a capital, that is he has invested in his business. That is how much he has invested. 10 lakh he has invested in his business. Out of 10 lakh, he has withdrawn 2 lakh rupees for his personal use. It is not for the business purpose, it is for his personal use. And that withdraw of money, we call that as a drawings. Now this 2 lakh, we call it as a drawings. When we call it as a drawings? When from the capital, if the owner withdraw the money or the goods for his personal use, and that we call it as a drawings. Okay, and always please remember, capital from capital we have to subtract drawings. Why we have to subtract? Minus drawing, because now, as I said here, we had 10 lakh as a capital, right? And we have invested in a business. But what happened is Ari, what he did, he withdrew 2 lakh rupees. Now, what is the total capital we have in our business? We have only 8 lakh rupees. Okay. So that is why we have to subtract the drawings and get the total amount. So always drawings should be subtracted with the from the capital. Okay. Let's move on to the next concept. Goods. Now, the goods is nothing but it's a product in which a dealer deals with. Now, this Hari, what I said, this Hari is dealing with some sort of business. For example, he is selling, let's assume that as per this stationery shop, okay, a stationery store he's running a business, a stationery store. He has opened a stationery store, wherein now what kind of goods he is selling, what kind of products he's selling? He's selling all the stationery items, right? It might be all the stationery, like all this in the picture I mentioned. So all the stationery items he is selling. So when a owner or the company, when they do the trading of a particular product, that we call it as a goods. Now here in this example, stationery items, we call that as a goods. Why? Because as owner, he has a stationery store, and in the stationery store, obviously, he will sell all the stationery items. So the stationery items he purchased for the purpose of selling, to get the generate some profit out of it. So that's the reason we call that products as a goods. The products in which a trader deals with. Now let me give you an example differentiation between an asset and the goods. Okay. Now, assets also purchased by the owner, goods also purchased by the owner. Let's give the same example of the stationery shop. Now, in the stationery shop, you may purchase a furniture. You purchase a furniture, fan, table, etc. Table, chair, etc. You purchase all the assets to your store, stationery store. Same way, you also purchase some stationery items. Okay, now both the products we have purchased, and this is purchased for the purpose of running the the business. But this products, whatever we have purchased, the stationery item, this is not meant for personal use. That is not for the business operation. This is meant for selling purpose. The stationery items, whatever the company has purchased, it is for the trading purpose, for selling the goods. Sorry, selling the products, and that we call it as a goods, the product which is bought by the business in order to sell it, and that kind of products we call it as a goods. Okay, now assets, usually we do not sell the assets, right? But we do not, whatever the computers or the furniture, fan, table, we do not sell this, but we sell the stationery items. That's the difference between an asset and the goods. Okay, and the goods is just nothing but the products which is meant to sell that you call it as goods. With the owner buy these products in order to, in the intention that he want to sell it and make a generate some kind of income out of it, and that we call it as a goods. Next concept, transaction. Now you can see that two person here, right? One person is a seller and one person is a buyer. Now she is buying the goods from him. Now he's selling and he's a buyer, right? This is a very simple, the transaction it is happening. An activity or a dealing involving the exchange of money. Now when she is buying the product with the exchange of product and the money, there is an exchange of money or money worth between two people. Now this person you call him as a buyer and this person you call him as a seller, right? When any dealing happens between the two people, when we are exchanging, it involves when there is exchange of money or money worth, that that kind of activity we call it as a transaction. Okay, now in transactions we have two types. One is cash transaction and another one credit transaction. Now for example, now if she now in this picture you can see, now she is paying the cash on the spot and she is buying, so this kind of transaction we call it as a cash transaction, when the cash is paid on the spot. If cash paid on spot, then we call that a transaction as a cash transaction. If in case, if the while at the time of transaction, if she doesn't pay the cash on the spot, but she will say that she will pay after 2 days, okay, or maybe 15 days, let's keep on the spot, she doesn't pay the money, and that type of transaction we call it as a credit transaction. Here cash is paid, cash is paid on future date. We don't know when, but let's assume as a future date, maybe after 2 months, 3 months. When the cash is not, whenever the transaction happens, when the buyer pay the cash on the spot, then we call it as a cash transaction. But when the buyer doesn't pay the cash on the spot, but later when he wants to pay the future date, and that kind of transaction we call it as a credit transaction. Okay. I hope I'm clear till here. Let's move on to the next concept. Vouchers. Now, voucher is nothing but it is when you go, when you visit a shop, there, when you purchase any products, the shopkeeper will give you a bill, right? A kind of a bill, it's a bill or an invoice. You can say it as a bill or an invoice, something. So, a document which is an evidence which supports the transaction. Now, in that bill, what do you see in that bill? You will see the product what you have purchased, right? What type of product you have purchased. Second thing, how much quantity you have purchased, and what is the price of that products, and date when you have purchased. So all the details can you see in the bill. That means that is a evidence that the transaction happened on that particular day, that how much of how much products we have purchased, and how much, what is the quantity, and what is the total price we have paid. Everything will be given in that bill. So that is a documentary, it is a evidence saying that the transaction has happened. So this voucher is just nothing but it is just a bill. It is a bill, or you can say it as an invoice. So what does this bill or invoice talks about? This voucher we call, it is just an document What kind of document? It is an evidence. It says that it's a proof that the transaction happened. It supports the transaction happened. Now, for example, now the supplier, okay, he's a owner, okay. Now he purchased the goods from the supplier. Let's give from the stationery items he has purchased from the supplier. Now, from a supplier he has purchased what he has purchased stationery items. Now he will take the bill, right? He has to take the bill. The owner has to take the bill from the supplier, that's for the purchasing of this the bill for the purchasing of stationery items. And that bill what he get, you call that as a voucher, okay, for the purchasing of stationery items. For purchasing the stationery items, he will collect the bill, and that bill we call it, it is an evidence. It's a documented evidence that says that it supports that the transaction has happened between the owner and the supplier for purchasing the stationery items. That bill contains all the details about the total number of products he purchased, what is the quantity price of for how much price he purchased, and when he purchased everything. All the details will be given in the bill. So that we call it as the document we call it as a voucher. Okay. We'll move to the next concept. Debtors. We don't pronounce this as a debtor. We usually pronounce it as a debtors. Now debtor is in a simple words. Let's assume. Now you can see these two people. They're very pretty people here. This person I have named as a debtor, and this you have named as a creditor. Now, for example, this his name is Hari. Now, Hari is giving the money to, let's assume this person name is Arya. Okay. Now, Hari is the owner of the company. He is giving money to Arya. Let's assume 5 lakh he is giving the money. Okay. Now, who is borrowing? Arya is borrowing from whom? From Hari. Okay, now Hari is giving the money to Arya. How much he is giving? 5 lakh rupees. And debtor are the person or entity who owes the money to the business. That means when he is giving the money, na, that we call that person, we call them as a debtor, the one who pay the money, the one who give the money, lend the money to the supplier or to a business or to any person, and that we call that person as a debtor. Okay, now here in this example, Hari is a debtor. Why he is a debtor? Because he is giving the money to Arya. He is lending the money to Arya. So here in our example, Hari is called as a debtor. Maybe Arya wanted to start, he want to start a business, okay, small store he want to start. For that he is giving a 5 lakh rupees. So here debtor is a Hari. Now who is a creditor? You might be have understood by now. So the person who has borrowed the money, that person we call them as a creditor. It's very simple. The person who has lent the money, we call them as a debtor. A person who has borrowed the money, we call them as a creditor. Okay. We'll go to the next concept, there you'll understand. The same way, creditor. Creditor is nothing but here. Creditor are the person or the entity to whom the business owes the money. Here, the one who has borrowed the money. Here, this Arya has borrowed the money. Na? So Arya has to pay the money to whom? To Hari. Okay. Now Hari is called as a creditor and Hari is called as a debtor. Okay. The one who borrowed the money, we call them as a creditor, and the one who has given the money, that is lend the money, and that person we call him as a debtor. It might be for a person they have borrowed, or a person has borrowed, or an organization was borrowed. That is different. But the whoever borrows the money, we call them as a creditor. Now, debtor is always an asset for the company and creditor is always a liability for the company. How it has happened? How do you say that it is a liability and it is an asset? Let's understand. Now, for example, this Hari has given Arya 5 lakh rupees, is it not an money which he has asset he has given to Arya? So he will be getting that 5 lakh back as because it is invested. He invested that 5 lakh to Arya. He has given to Arya. So this 5 lakh is an asset. It's a cash which is given to Arya. It is an investment. So it is an asset for Hari. That is for his business. It is an asset. But when I'm talking in terms of Arya, then it's a liability. Why? Because Arya is supposed to pay back 5 lakh rupees to Ari. So hence, so creditor is always considered as a liability because we have borrowed, as I said in the previous terms, liability is nothing but when the company borrow the money and it creates an obligation to repay back that money. Here, Arya has borrowed the money from Hari. How much rupees? 5 lakh rupees. Now it became an obligation that he has to pay this 5 lakh back to Hari, so that then the creditor, who is it? It creates a liability, obviously. Then creditor is always considered as a liability and debtor is an asset. Always it is an asset for us. Okay. I hope I'm clear till here. Next concept, sales and revenue. Now here, sales and revenue. First, let's understand the meaning of revenue. Now, sales or income means the earnings of the business from sale of goods or from rendering services. Now, for example, now this person is selling the goods and he is earning some kind of income. Let's assume like the stationery, okay? The stationery store is selling the stationery items and they are earning some kind of income. That income we call it as a revenue, okay? The whatever the cash it is generated, the earning it is generated by selling the goods. Now I have explained you about the goods already, right? The products which are meant to sell, right? So when as a stationery store, as an example, in a stationery store, we sell all the stationery items. When we sell that, the earning what the company, the shop earns, that earning we call it as a revenue, okay? The earning what the company, this stationery shop earns, that we call it as a revenue. Now moving on to the sales. Now sales is nothing but what is a total revenue from the goods sold. Now how much goods I have sold. Here we, when we are talking about the sales, we consider the quantity of goods. We do not consider what is a total price. Total cost we do not consider. When we are talking in total sales is nothing but the total quantity of goods we have sold or the services we have provided. Here we are considering the quantity. The total sales are the total revenue. What is the total revenue from the goods sold, or the total is the total income what we generated by the goods sold or the service provided. Okay, that's a difference, a slight difference between the sales and the revenue. Next concept. What is profit? Now, yeah, profit is nothing but, now let's understand with an example. Let's assume to manufacture a product, let's assume to manufacture pen for a manufacturer, it costed, let's assume 10 rupees. The manufacturing cost of a pen is 10 rupees. Fine. Now this is an expenses, right? This is an expense which is incurred in order to manufacture a pen. What is the total price he is paying? 10 rupees he has already. It's an expenses. Now, if he sell the pen for rupees 15, then we call that as a, is it not a more income we have got? Like 10 rupees pen, we have sold it for 15 rupees. So now how much is a profit we have got? 5 rupees is a profit. Now you can see the formula here. Profit is equal to revenue minus expenses. Now moving on to the formula, profit is equal to revenue minus expenses. With let's apply this formula here. Now what is the total revenue we have generated? 15 rupees. Now what is the total expenses we have incurred? 10 rupees. Now profit is 5 rupees. Okay, that is whatever the expenses we incurred is 10 rupees, but we sold that pen for 15 rupees. So that 5 rupees what we extra we got, and that 5 rupees we call it as a profit. Always the revenue should be more than expenses, then that we call it as a profit. Okay. Next concept. This is your last concept for today's video. What is loss? Same example, let's take. Okay. Now here, manufacturing expenses costed 10 rupees per pen. Okay. Now he sold it. He sold, that is revenue. He sold the pen for rupees 8 per pen. Now what happened? The total cost to manufacture that pen was 10 rupees, but he sold it in the market for 8 rupees. Now, is it not a loss for him? He got a loss because expenses are more than the revenue, right? That we call it as a loss. Okay. When expenses are more than income, then we call that as loss. When income is more than expenses, then it is a profit. When expenses are more than income, then we call that as a loss. The excess of expenses of a period over its related revenues is termed as a loss. The money lost without receiving any kind of benefit. He's not getting any benefit. So that kind of loss, that we call it as a loss. Okay. Thanks for watching, dear students. If you understood the concept, then please do like, share, and subscribe to my channel. And if you have any doubts, you can ask me in the comment section. And please do, if you're willing to give any feedback, surely you can give the feedback too. Thank you.